Hello, welcome. Thank you for tuning in today to the Cedar River Capital 2020 Mid-Year Update. My name is Paul Latta. I have with me my business partner, Baj Kochar, and today we're going to talk about our market touchstones. Market touchstones is curated from a variety of mostly public sources, the Wall Street Journal, Bloomberg FactSet, as well as some street research. The slides that follow, we believe, represent the most important factors in the market today. Today's investment landscape is unique for both its simplicity as well as its complexity. It seems in past issues of our Touchstone report, this slide had more line items, things like healthcare legislation or tax legislation or US interest rates up, down, or the currency up, down. Today, however, it's predominantly about COVID. And COVID may be a simple cause, but with a complex effect. It does run through every country in the world and in different ways, and it runs through every industry in the world and in different ways. A very complex effect. Of course, this is an election year, so there are other things going on in the background, and there's other things like the China trade war that's going on. So we don't want to forget about those. But today it's predominantly about COVID. Let's look at COVID in just a little bit more detail. I like this particular chart because it shows how coronavirus fits within the constellation of other viruses in terms of deadliness and in terms of contagiousness. And you can see the deadliness, which is on the vertical scale, and the contagiousness, which is on the horizontal scale. Down on the bottom left, you have the common flu, so not very contagious and not very deadly. Coronavirus, circled in red, just a little bit up and to the right of the common flu, does appear to be more contagious and more deadly. However, it's clearly not as deadly as, say, the Ebola or the HIV, nor as contagious as say, dengue fever, way out to the right. There is a lot of uncertainty in the numbers, and the numbers are still evolving. And that current location of coronavirus within this constellation will likely shift a little bit up, down, and left or right. It's hard to say where it will go over the next year or two, but it probably will take a year or two for the numbers to fully stabilize. In the meantime, this is the best we have right now in terms of understanding where it fits within the constellation. The COVID pandemic is a global phenomenon. And with a global phenomenon, you do run into challenges with differing approaches to how data is gathered, how data is interpreted, making it very difficult to put together world statistics of COVID or coronavirus deaths or caseload. However, in particular, there seems to be a suggestion that some of the non-democratic governments are actually fiddling with their numbers. And you can see this in these two charts. On the chart on the left, you can see over the last 60 years, that there's a tendency for the democratic governments to have slightly lower death rates than the non-democratic governments. In other words, the dark blue line is a little bit lower than the light blue line. However, on the chart on the right, which is COVID or coronavirus, you can see the non-democratic countries, the China, the Russia, Saudi Arabia on the left, are actually seeing lower death rates than the democracies. Pretty sure this is not that the virus is seeking out democracies, but it does seem more likely that there's some fiddling with the numbers on the part of the autocratic governments. Perhaps it could be an interpretation issue or a gathering issue or other more honest issues, but it does seem, regardless, like the numbers are of questionable quality. This does raise the issue, again, of trying to understand. It's difficult enough to have faith in just the US numbers, but the world numbers are even more difficult to understand and get your arms around. We're going to move on from these COVID details and talk a little bit about the economy now. I'm going to introduce my partner, Baj Kochar, talk a little bit about how gross domestic product forecasts are shaping up and whatnot. Baj, can you take it from here?
We have seen rapid and dramatic revisions to gross domestic product forecasts. In March, the forecast for the decline of gross domestic product in the second quarter of 2020 was a negative 13%. The current forecast is negative 34%. That's quite a dramatic decline and much more severe than prior recessions. Interestingly, the third quarter forecast is for a growth rate of 13.5%. The prior forecast was a growth rate of 6.5%. Technically, that means we are out of recession and that the economy is growing again, even if it is from a very depressed level. Now, it's possible we'll see that growth revision revised downward, that growth number revised downward as COVID reinfections rates increase and as a second wave appears to be taking hold. So even though we've seen markets recover substantially from their March lows, we are likely to see continued volatility as fears emerge that this growth rate might be revised downward. In April of 2020, we saw the unemployment rate rise to about 17%. That's 2 to 3 times higher than any prior recession since the 1970s, and comparable to the unemployment rate we saw during the Great Depression. Interestingly, that unemployment rate has since then gone down. The June unemployment number was reported to be 13.3%. So quite an improvement from the 17% unemployment rate we saw in April, but still significantly higher than the peak unemployment levels we saw in the 1975, 82, 91, 2001, and 2009 recessions. We also saw quite a significant surge in temporary layoffs, with the layoffs number during the COVID-19 crisis being dramatically higher than the financial crisis of 2008 and 2009 and the recessions of the 1980s and 1991. We've seen a sizable fiscal and monetary response to the COVID crisis. The $2 trillion aid package known as the CARES Act included $1,200 checks to every individual making less than $100,000 a year, $500 billion in bridge loans to businesses, and other aid packages including increased unemployment benefits, suspension of student loans, and restrictions on foreclosures and evictions. We are also seeing an additional aid package being discussed in Congress right now of $3 trillion. We've seen unprecedented monetary intervention from the Federal Reserve, much more aggressive than the 2008 and 2009 crisis. We've seen uncapped quantitative easing from the Fed. Prior QE has been capped. And for the first time in history, we saw the Fed purchase corporate bonds, including high-yield bonds. Fed quantitative easing is inflating bond prices and suppressing bond yields, and this newly printed capital is already flowing into equity markets. To put this in context, let's study the chart on the left, which is the Fed balance sheet from 2007 to the present. During the 2008 and 2009 financial crisis, the Ben Bernanke-led Federal Reserve took a somewhat unprecedented step of aggressively expanding the Fed's balance sheet. And during that period, the Fed's balance sheet expanded from about $1 trillion in mid-2008 to about $4.5 trillion by mid-2014, over a period of 6 years. The current round of quantitative easing has expanded the Fed balance sheet from $4 trillion to $7 trillion in less than 3 months. So quite an aggressive intervention by the Fed and a much more aggressive round of quantitative easing in a shorter period of time than the prior downturn. This has had a significant effect on the yield curve. In December 2019, we saw the 30-year Treasury rate at about 2.5%, and the Fed funds rate, which is essentially set by the Federal Reserve, was 1.5%. The current rate is 0% for short-term bonds, and the 10-year Treasury is trading at about 0.7%. So the combination of the flight to safety and the Federal Reserve intervening very aggressively in bond markets has pushed bond yields down to historic lows. And as a result of this, pushing investors into both money market funds and into equities.
Thank you, Baj. With the Fed actively buying bonds in the bond market, that does raise the question, how has the bond market changed over the last 10, 15 years, or perhaps since the last recession, 2008? What's on the Fed's plate? A chart on the left in particular shows one dramatic change, and that's that the number of triple B issuances has grown at a much faster pace than the double A, the single A, the double A, and the triple A. So what's on the Fed's plate? Well, there's going to be a lot more triple Bs, in particular if it's stepping into the corporate bond market. Why is that? Now, the chart on the right does give at least one explanation, pointing the finger in particular at the bond rating agencies, Moody's, S&P, and Fitch, and pointing out that if you look at a triple B issuance back in 2007, debt to EBITDA back then was running for a typical triple B probably around 2.4, 2.5, but in more recent times it's running closer to a 2.8. And so there's been a little bit of great inflation taking part on the part of the bond rating agencies. Now, in defense of the bond analysts, you might also note that the interest rate is a little bit lower today versus 2007. And so the interest burden to EBITDA is probably not quite as egregious as the debt to EBITDA. So cut the analysts just a little slack there, but it is still probably a fair point to make that there's been a little bit of great inflation, not as much as debt to EBITDA would suggest, but a little bit. Regardless, the triple B issuance is still a very high number, and that is what the Fed is going to be looking at if it's going to be buying bonds of all stripes going forward. This chart provides a little bit of color on the consumer experience from the monetary side, the personal consumption, the personal savings rate, the change in consumer prices. I'd like to start with the chart in the middle on the personal savings rate. What's interesting about this chart is if you look back over many years, there's been concern from economists about whether America's personal savings rate is too low. Well, clearly with the pandemic, the savings rate has absolutely spiked. So we're probably not going to be seeing too many more economist publications, at least while we're amid the pandemic, about savings rate being too low. The savings rate has actually improved dramatically. Of course, that has happened at the expense of personal consumption, as you can see on the left. Consumption has dropped quite precipitously with the pandemic. And you can see on the right that the consumer prices have also dropped in most of the regions of the world. So personal savings rate is up, but consumption is down and prices are down. With the spike in the personal savings rate we saw on the prior slide, it's probably no surprise that assets in retail and institutional money market funds has also spiked. And you can see in the right side of this chart, just prior to the COVID situation, that money market assets were running right around 3.3 trillion, and they spiked all the way up to 4.5 trillion in just a matter of a couple of months. Now, we've seen this before, of course. The 2008 recession, we saw quite a lift in money market assets as well. And then we saw as the economy came out of recession, the money came back out of the money market assets and went into stock markets and real estate assets and other asset classes. And in fact, people have a tendency to regard this chart as a measure of dry powder for additional equity appreciation. So when you see a big spike in money market, frequently that can be regarded as a buying signal for additional equity appreciation.
Equity markets typically bottom several months before GDP growth resumes. During the 2008 and 2009 downturn, equity markets bottomed in March of 2009, nearly 6 months before GDP growth turned positive. As you can see from the table on the left, economic activity turned negative in the first quarter of 2008, and for the most part stayed weak until the third quarter of 2009. The equity markets, however, bottomed in the first quarter of 2009, actually March of 2009, 6 months before GDP growth resumed. The current COVID-related downturn saw the same thing happen. Equity markets bottomed in March of 2020, several months before economic growth resumed. We may see continued volatility going forward as the economy grows in fits and starts related to COVID reinfection rates. But equity markets are typically strong several months before economic activity is strong. Equity markets are an anticipatory mechanism. They anticipate economic activity several months before that economic activity happens and plays out. Equity markets rallied even as COVID-19 infection rates were increasing. A second and third wave of new infections will likely cause more market volatility. As you can see from the two overlaid graphs here, the equity markets bottomed in March of 2020, while the COVID infection rates were just beginning to rise. And even as the COVID infection rates saw a dramatic increase from March of 2020 to April of 2020, the equity markets rallied. The equity markets continued to rally as the COVID infection rates declined. We're likely to see more market volatility going forward, particularly if we see a meaningful second wave of COVID infections. However, the number of COVID infections may not be a good indicator of where equity markets are going. The widely predicted lower bottom in April of 2020 never happened, and investors waiting for a lower low than what we saw in March never got back into the markets and missed the recovery. Stocks are cheap compared to bonds. While equity markets have recovered most of their COVID-19 losses, equity earnings yields remain inexpensive relative to bond yields. What we're looking at is a relationship between equity earnings yields and bond yields. The equity earnings yields is the inverse of the price to earnings ratio, or earnings over the price. It's currently at about 4.7%, the equity earnings yields. It's basically if you own the entire index, what would you make on your investment each year if you just kept the earnings? And that would be about a 4.7% yield. By comparison, the 10-year US Treasury bond yield is about 0.77% on 6/12/2020, making bonds dramatically more expensive than equities at this juncture. Now, what's interesting is that for most of the last several decades, these numbers were highly correlated, and that correlation broke apart in the late 90s, initially in favor of equities, but later in favor of bonds in terms of bond prices. We've seen quite a dramatic inflation of bond prices and a decline in bond yields. And while we've seen equity market appreciation, we've not seen nearly the decline in equity earnings yields that we've seen in bond yields. So relative to bonds, equities are actually very cheap. Even if equities look in line with historic valuations, they represent a far better value than bonds at this juncture. Bear markets frequently lead to bull markets. In all of the bear markets of the last century, the drawdowns varied anywhere from 29% to a drawdown of 86% during the Great Depression. The 1, 3, and 5-year returns after the recession was over were extraordinary. The average 1-year return after a bear market was 52%, the average 3-year return was 89%, and the average 5-year return was 132%. Attempting to time the market is often very difficult, and many investors miss the bottom and then end up missing an extraordinary bull market and are left with chasing a rising market afterwards.
One of the interesting features of the stock market in the last few months has been the dramatic increase in the participation of individual investors or retail investors. Quite a few articles out there talking about the big spike in new accounts opened at online trading platforms like E-Trade, Ameritrade, and a poster child there seems to be a shop called Robinhood Securities, a shop that seems to have a strong attraction to millennial investors in particular. Perhaps millennials sitting at home flush with their $1,200 stimulus checks were able to reinvest that capital into the stock market, a strategy which so far has actually fared quite well. And not just because the overall stock market has gone up, but also because the retail trading favorites have actually dramatically outperformed the overall stock market. And you can see that in the chart on the left in the light blue line. The retail trading favorites have dramatically outperformed the S&P. Institutional investors, not so much. The table on the right shows the institutional favorites compared to the retail favorites. And you can see the institutional favorite names are dominated by financial technology names like Visa, MasterCard, PayPal, as well as mega cap technology companies like Microsoft and Google. Retail investors, in contrast, are drawn more towards consumer names, lower priced stocks, and in particular, travel stocks, Delta Airlines, American Airlines, Walt Disney, Carnival Cruise Lines. Going forward, it seems unlikely that the retail investors will continue to have the edge over the institutional investors, and in particular, the vulnerability seems to be in those travel stocks. The institutional investors seem to be avoiding those travel stocks mainly because of the bankruptcy risk, and it does not seem to be a feature deeply appreciated by the retail investor, and we'll go into that in the next two slides. Let's look at the airline industry in just a little bit more detail. The airlines seem to be a battleground industry between the bullish individual investors and the bearish institutional investors. The chart on the left shows the number of commercial air passengers screened by the TSA, and clearly that number has started to recover. Saw that low water mark there in middle of April, April 14th, and now the arrow's pointing up. So clearly that's a bullish sign and in support of the individual investors and their investment thesis. But the longer term investors, their thesis is not about the industry recovering tomorrow, the day after, the week after, but rather how long will it take for a very high fixed cost industry to get back to normal. And the problem is that coronavirus does have a tendency to taint demand. And in a long-term view, that people are still going to be spooked about catching disease, and people are going to be spooked about being cramped up into tight spaces with lots of other people. This is not just limited to the airline industry, of course. The cruise line industry is really high on that list. That's going to see a long-term demand deterioration. The restaurant industry, long-term demand deterioration. These concert venues, sporting venues, all areas with large crowds of people have a very similar scenario where the longer term demand just won't be what it was prior to coronavirus. We can put some numbers on that for the airline industry in particular on the chart on the right, and you can see that the 2023 airline revenue, the consensus estimate for 2023 keeps dropping. And you can see it was creeping up a little bit in January, February, and then March, coronavirus hit, and the analysts started slashing estimates. And today, those estimates are actually lower for the year 2023 than where the revenues were in 2019. And the challenge, of course, for airlines in particular is that the airlines are a high fixed cost business, and when the revenues come in just a little bit short, you get a dramatic shortfall on the profit line. The profits rapidly turn into fairly sizable losses. We'll talk a little bit about that on the next slide. Many of us have fond memories of a flight to Hawaii or a flight to Disney World, but from an investor's perspective, the airline industry has not been so kind. The industry has a history of bankruptcies dating back to the 1980s deregulation and has always been a very delicate industry in terms of its ability or inability to drive profits to the bottom line in a persistent way. The industry is also very economically sensitive, and as we've seen earlier in the slide deck, we are seeing an economic contraction unprecedented this century in the second quarter, and one that we're not likely to recover from so quickly. To put some numbers on this, if you look at American Airlines as just an anecdotal example here, American right now is trading around $16 a share, but the loss estimates for 2020 are right now coming in at $16 a share, which is the same as the stock price, but in other words, it's going to lose the entire stock market capitalization in 1 year. Further, those numbers seem likely to get worse. Most of the new estimates that are coming in are actually coming in lower than $16 a share, and the current street low is a loss of $26 a share. So the losses will be profound there, and not just at American Airlines. I don't want to pick on just American, because the fact is it's hitting all the other airlines virtually identically, whether it be Southwest or United or Delta or Alaska or JetBlue. The airline industry in general is facing the exact same problem at the same time, a massive economic contraction. And while they are seeing some improvement in traffic, they're coming off such a deep level that it's not going to be enough to get them out of the hole by year end, and the estimates are just dramatically contracting still. Since the likelihood of covenant violation is so high, and in any other environment, this would likely be bankruptcy scenario for any individual airline. But since it's all happening at the same time to all the players, as well as the banks themselves being under pressure, there is a decent chance that we might get some sort of government bailout to help the airlines. That could come in the form of some sort of advantageous financing arrangement. or it could come in the form of, we saw with Citigroup in 2008-2009, they had a conservatorship where the government actually took a stake in the company. So we could have the government taking a stake, or the government could outright expropriate some of the airlines. I know that's not very popular in the U.S. to go with expropriation, but it's actually fairly common outside the U.S. I might mention that the airline industry is not the only travel industry category that is being impacted. The cruise lines come to mind because the cruise lines have a virtually identical situation. The cruise lines are an even higher fixed cost industry, and while their profit trends have actually been a little bit more persistent than the airlines, the one thing the cruise lines do not have is the government backing, because most cruise lines, well, they don't pay any taxes because they're not headquartered in any country. They're headquartered in the open seas. And with not being a taxpayer in any country, the likelihood of a government bailout is pretty slim. So the cruise lines actually have perhaps an even more dire outlook than the airlines. This threat of survivability is, in essence, why Warren Buffett sold all his airline stocks in the March quarter. He was one of the first sellers, and a fairly high-profile one at that. So he's the one that's at the vanguard of the institutional investors being bearish on the airlines, going head-to-head with the Robinhood investors who are bullish on the airlines. We clearly side with Warren Buffett. We think that the risk of survivability is just too great for us to participate in the airlines, and we just think we should move to greener pastures. I have a couple of charts here on the oil industry. Of course, oil is very important to geopolitics and therefore the stock market. Also, the mega cap oil companies, the Exxon, the Chevron, BP, Royal Dutch, well, those are important components of the stock market too. So we need to keep an eye on the oil industry. The chart on the left, you can see in red the price of Brent crude oil going back over 20 years, including the collapse here in 2020, mainly related to the coronavirus. Been quite a few other explanations, strengthening dollar, some cheating on the part of OPEC members. But I think the simple way to look at it is just keep it simple. The coronavirus basically crushed demand, and the prices responded accordingly. Tough to be an OPEC country in this environment, given the weak demand and weak pricing environment. But the chart on the right adds yet another element. You can see crude oil production, that crude oil production percent of world total, that the United States keeps increasing its market share, and that's coming from its hydraulic fractionation, or the frackers in the US keep stealing market share from the other countries, including the OPEC countries. They're part of cartel, and when non-cartel members like the US continue to take share, that makes it harder for the cartel to retain cohesiveness. And so OPEC is really in a troubled position right now. It's effectively lost its teeth right now. It may regain the teeth at some future date, but for now, OPEC is a toothless tiger.
We have developed an approach to thinking about the various industries in the economy and markets amid the COVID pandemic. Below we have our COVID-19 investment roadmap, which highlights the industries with headwinds and those with tailwinds, and tries to distinguish among those industries with short-term headwinds, long-term headwinds, and as well as industries that will be both short and long-term beneficiaries of changes in consumer behavior. In full disclosure, we do not own any of the names listed on this slide. We did that by intention. We own names in some of these industries, but not the ones on this slide. And this is not a specific recommendation to buy or short sell any of the stocks on this slide. It's merely a discussion of the different names and industries for illustrative purposes. So industries that have seen a short-term change as well as a long-term change would be examples of this would be some of the technology companies, the stay-at-home companies like Zoom video conferencing, as well as Netflix and the video game companies. They saw very significant growth last quarter. Zoom, for example, saw 173% year-over-year growth. It probably won't grow that much again in 2021, but it probably also will not decline back to pre-COVID levels, rather. They are likely at a permanently higher revenue base than they were pre-COVID. Same with Netflix. They saw an acceleration of revenue growth to 28% year over year. Probably will not see a similar amount of growth in 2021, but they probably will not see revenues decline back to pre-COVID levels. So these industries have both a short-term and a long-term benefit in terms of revenue and profitability from COVID, although the stocks and the valuations very much reflect that. The bottom left corner talks about a few industries which have seen a short-term spike in earnings but are unlikely to see a long-term higher earnings level. An example of that would be the toilet paper companies. Consumers have stocked up on toilet paper during the pandemic due to fear of shortages. They will probably work through those stockpiles, and toilet paper company earnings are likely to fall back to regular levels. On the bottom right-hand corner, we have a few examples of companies that have seen a short-term decline in earnings, but will probably see higher than normal earnings going forward due to backlog demand. And an example of that would be an orthopedic company or a medical device company. If patients have postponed an elective surgery, they are likely to need that surgery at some point. And so the backlog of items, of orthopedic items and hospital capital equipment expenditures is likely to grow and then be fulfilled within the next couple of years. And some industries which have seen short-term declines and may also experience long-term declines are travel-related industries as well as business development companies. The airlines and cruise lines saw a very significant fall off in demand during the pandemic, and it may be years before consumer behavior comes back to pre-pandemic levels. In the meantime, they've had to take on additional debt and in some cases issue new equity. So it might be a long time before their market caps return to pre-COVID levels.
At the very beginning of the slideshow, we talked about the fact that there were two main factors influencing the stock market. Number one was COVID-19, of course, and we've been chatting about that quite a bit. Number two was everything else. I'd like to talk a little bit more about the non-COVID factors. And I think in that category, there's three main non-COVID factors influencing the stock market today. Quite a bit of discussion about high debt levels, and of course, quite a bit of headlines around the China trade war for the last few years. And let's not forget that 2020 is an election year.
High federal debt levels will increase. We've already seen a pretty significant growth in the federal debt levels since the Tax Cut and Jobs Act of 2017, which prevented a pay down of the excess debt accumulated as a result of the 2008 and 2009 recession. But low interest rates have helped reduce that burden, especially compared to the double-digit interest rates of the late 70s and early 80s. COVID-19 will likely lift the U.S. debt to GDP ratio to 120 to 130% over the next 1 to 2 years, both from a combination of lower tax revenues and extraordinarily large stimulus payments. It's possible we may also see a downgrade of U.S. debt by the rating agencies. So the implication of that is potentially higher long-term interest rates. We are very likely to see the 10-year bond rise from its current rate of 0.67% when the Fed begins to taper quantitative easing and investors start to grapple with a much higher federal debt level.
China trade war in the headlines quite a lot the last 2 or 3 years, but not so much in the last few months. Of course, COVID is just dominating headlines, so it's a little difficult for any issue to make it into the headlines these days that's not coronavirus. That said, America did reach a phase one deal of sorts at the tail end of last year, and while it did not address the elephant in the room, the intellectual property theft, it did make some modest progress in the agricultural area. I don't think it's going to be a high priority for America, and I think China's best plan from here is basically stonewalling through the November election. I put this chart in here actually showing China reclaiming status as America's largest trading partner, mainly because I think politicians will discuss it in particular as we get closer to election. And so it probably helps to clear the air just a little bit here. I think the main bounce in the China trade versus the decline in the Canada-Mexico trade was mainly related to pandemic effects rather than trade war effects. And in particular, when you think about Canada-Mexico and when you think about imports that we're bringing in from Canada-Mexico versus imports from China, well, the imports from Canada-Mexico have a tendency to be on the mid to early part of the value chain, whereas it's mid to late part of the value chain for China, which means the Canadian and Mexican imports are more sensitive to pricing and demand fluctuations. So the coronavirus impact to Canadian and Mexican imports, those numbers are going to decline a lot sharper. Again, not really related to the trade war at all. It's clearly related to the pandemic, but I do think politicians will dig this up and start talking about whether we've made progress or no progress on the Chinese trade war based on China now being our largest trading partner. A lot of noise in those numbers.
The average election year market return is 11.3%. This is very close to the long-term average of 11% for election and non-election years. Market returns during election years are only partially affected by the candidates and their proposed policies. Economic growth or decline, interest rates, Fed policy, trade policy, and many other variables affect market returns as well during both election and non-election years. And for 2020 year to date, the spread of and recovery from the coronavirus has outweighed most market moves related to the upcoming presidential election.
Thank you again for listening to our Cedar River Capital Mid-Year 2020 Market Touchstones Report. Please feel free to reach out and ping us if you have any questions or comments. Please take a look at our website, cedarrivercapital.com. And again, thank you for listening and thank you for tuning in.